If you're holding SCHD or thinking about buying in, 2025 has probably left you wondering what's going on. Prices are dropping, tech is flying high, and your favorite dividend ETF seems to be falling behind. But before you hit the panic button or walk away, stop and ask yourself, is this a warning sign or the buying opportunity of the year? In this video, we're breaking it all down. No hype, no guesswork, just the facts that matter. Why SCHD is underperforming, what's happening behind the scenes, and most importantly, whether this is the time to buy more, hold tight, or make a move. We'll also reveal surprising dividend data, market shifts you're not hearing on the news, and a long-term strategy that could turn today's dip into tomorrow's gains. So don't skip ahead, because by the end of this video, you'll know exactly where SCHD stands and what it could mean for your portfolio in 2025 and beyond. Let's dive in. For a long time, SCHD's been a favourite among those chasing steady income. But as 2025 unfolds, the picture is changing. This year, SCHD has dropped around 7%, a surprise to many. In contrast, the S&P 500 is moving up, mainly thanks to rising tech giants like Nvidia, Apple, and Microsoft. So the big question is, has SCHD lost its momentum? Or is this the ideal moment to grab more shares while it's down? Chapter 1. How SCHD is doing right now, March 2025. Let's begin with the current state. So far in 2025, SCHD has slipped around 7%, not the kind of result investors were counting on. Meanwhile, the overall market, especially tech-driven stocks, is climbing. Here's why SCHD is falling behind. Banking stocks, a major part of the fund, are being hit hard by rising rates. Household product companies are showing weaker profits, and even medical sector picks, normally stable, are not helping SCHD move up. All of this has weighed down the fund's performance. Here's what might surprise you. SCHD now pays more. Even though SCHD's share value has slipped, the income payout rate has gone up. With the price lower, the dividend return is now above 4%, making it more tempting for people who rely on regular cash flow from their investments. So yes, the value dropped, but the payout got better. But something else is also happening. Some investors are shifting their cash into other funds chasing faster profits, especially in tech. That move has added extra downward pressure on SCHD. Now here's what we really need to ask. Is this just short-term movement or part of a bigger shift? To figure that out, we have to dig into what's really causing the drop. Chapter 2. What's behind SCHD's dip in 2025? This decline isn't random, it's following clear market patterns. Let's unpack the key reasons. Right now, the spotlight is on fast-rising companies, especially in technology and AI. Those kinds of businesses are getting most of the attention and money. But SCHD leans towards stable companies that pay dividends, often called value stocks. As more people chase high-growth opportunities, funds like SCHD have seen money flow out. Then there's the issue of higher interest rates. The central bank has kept borrowing costs elevated, which affects SCHD in two big ways. It puts pressure on bank stocks, a large part of SCHD, by reducing their ability to earn. And it gives investors other ways to earn, like government bonds, without taking much risk. So between rising interest rates and shifting investor focus, SCHD is facing real headwinds in 2025. Why choose risk when bonds pay more? Think about it. If a government bond pays 5% with almost no risk, why would anyone take a chance on SCHD offering 4%? But the challenge goes deeper. SCHD has big exposure to finance, consumer goods, and healthcare. Banks are struggling with more loan defaults and fewer people borrowing money. Consumer brands like Pepsi, Coke, and P&G are feeling the weight of rising costs and weaker demand. Even healthcare stocks, usually steady, are falling behind this year. Then came the 2025 reshuffle. Every March, SCHD updates its lineup based on strict rules for dividends and company performance. This year, some top performers were removed or downgraded, leading to a quick shake-up. Some investors pulled out during this transition, causing extra selling. And like we said earlier, money is moving out of SCHD and into funds that are doing better, especially growth-focused ETFs and individual high-flyer stocks. This kind of switching adds even more pressure on SCHD's share price. To wrap this all up, SCHD's dip comes from growth stocks stealing the spotlight, high interest rates pulling attention away, key sectors like finance and staples under-delivering, and investors rotating money elsewhere. But here's the twist. SCHD's dividend power hasn't faded, and that's what long-term investors really care about. Chapter 3. SCHD's dividend game is still strong in 2025. Even with prices falling, SCHD's payouts are rising. The yield now ranges from 3.5 to 3.88%, which is more than double what the S&P 500 is offering. That's a big win if you're building for income. And it gets better. SCHD's dividend growth over the past decade has averaged around 11% per year, showing real compounding strength. And in 2025, that growth isn't slowing. Dividends are already up 12.2% from last year. If you reinvest those payouts, your returns can snowball. Here's why that matters. Say you invest $10,000 in SCHD now. With consistent dividend increases in 10 years, your yield on cost could be over 10%. That's a stream of passive income that keeps rising year after year. So even though the price is down, the foundation is still solid. And that's why many smart investors are seeing this drop not as a problem, but as a potential buying window. Chapter 4. Should you add, keep, or let go of SCHD? What should you actually do with SCHD right now? Buy more, stay put, or cash out and shift? Let's go through each option. 1. Thinking about buying? Here's why it might make sense. SCHD is down roughly 7%, and that means it's currently priced lower. You're also getting a higher dividend yield, which makes it even more appealing if you believe in its long-term strength. Plus, past patterns show SCHD has often bounced back after short-term drops. If the market shifts back to favor value and dividend stocks, SCHD could rebound, rewarding those who stay consistent. 2. Already own SCHD? Here's the case for holding. If you're already in, holding might be the smart move. Why? The fund's core structure is still solid. Dividends keep rising. It's spread across many industries and is built for long-term wealth building. If you don't urgently need the cash, you could simply keep collecting dividends and let the investment compound over time. 3. Thinking of selling? It's all about strategy. Selling might make sense depending on your personal goals. If you're chasing quick growth, SCHD may feel too slow, especially while tech stocks are leading the charge. And if you're concerned that higher interest rates will continue to weigh on dividend funds, it might be smart to shift part of your money into growth-focused ETFs or more aggressive strategies. So, what's the right move? It all depends on your financial plan. Buy if you want to grow long-term income at a discount. Hold if you trust the fund and enjoy steady payouts. Sell if you're aiming for faster returns or a more aggressive portfolio. Whatever path you take, the key is to align your choice with your bigger investment goals. Looking for steady income? SCHD still has your back. If you're aiming for consistent cash flow from your investments, SCHD remains a reliable option. But if you're focused on fast-moving gains, you might want to explore other routes. Truth is, there's no single right answer. But here's what's clear. SCHD isn't broken. It's just facing a temporary slowdown. And for patient investors, that could mean a window of opportunity. Chapter 5. Final thoughts. What's SCHD's position in 2025? Here's the reality. SCHD has taken a dip this year. But does that mean it's a poor performer? Not quite. Its share values may be down, but the dividends are rising. The payout rate is higher, and its history of delivering long-term results is still strong. If you're investing for ongoing income, this might be a chance to scoop up shares while they're cheaper. On the flip side, if you're looking for quick returns, SCHD might not be your best fit, especially with tech stocks leading the market. So, what's the move? That depends entirely on your investment direction. If you back SCHD's method, staying in or buying more while it's undervalued could pay off over time. If you're chasing growth, it may be time to shift towards more aggressive assets. At the end of the day, SCHD isn't failing. It's just not the star of the show right now. And that's often when the smartest investors step in. The market always moves, but strategy wins. Remember, every market cycle brings both fear and opportunity. While others may panic or chase trends, smart investors focus on what truly builds wealth: discipline, patience, and a plan that fits their goals. SCHD isn't about overnight success, it's about building something steady, one dividend at a time. So, whether you're holding, buying, or shifting lanes, stay focused, stay consistent, and don't let short-term noise shake your long-term vision. Because at the end of the day, it's not about timing the market, it's about time in the market and the power of compound growth. Your turn. Is SCHD a good pick at today's price? Drop your take in the comments. And as always, thanks for watching. See you in the next one. Here's to your investing success. Profitable investing.